What if the bank you've trusted for years doesn't actually see you as a customer? What if the difference between someone with $0 and someone with 50 million isn't just the size of their bank account, but the rules of the entire financial system? Most people believe banks treat everyone equally. After all, money is money. A dollar is worth the same no matter who owns it. But that's not what is actually happening. Behind every smiling teller, premium credit card, mortgage approval, and private banker lies an invisible ranking system, one that quietly determines how much attention you receive, how quickly your problems are solved, what financial opportunities appear before you, and even how expensive money becomes. The strange part is that this system isn't based on fairness, it's based on profitability. Banks don't simply store money, they classify people. And the higher your wealth climbs, the less the bank behaves like a lender, and the more it behaves like a business partner. This is the hidden operating system behind modern finance. Let's begin at zero. Level 1, $0, the risk category. Imagine walking into a bank with no savings, no investments, and very little credit history. You believe you're opening a bank account. The bank believes it's opening a file. At first glance, this seems cold, but the real reason is simple. Banks make money by predicting human behavior. Someone with no assets is statistically harder to predict. Income may be unstable. Unexpected expenses happen more frequently. Overdrafts become common. Loan defaults become more likely. Fraud risk increases. From the bank's perspective, uncertainty is expensive. So instead of rewarding this customer, the system surrounds them with rules. Minimum balance requirements. Overdraft fees, monthly maintenance fees. Strict lending standards. Most people assume these fees exist to punish bad financial habits, but that's not what is actually happening. They exist because uncertainty costs money. The psychological impact is powerful. Scarcity changes behavior. People become afraid of making mistakes. They avoid asking questions. They accept terms they don't fully understand. Fear quietly replaces confidence. And when fear controls financial decisions, long-term wealth becomes much harder to build. Level 2, $10,000, the predictable customer. Now imagine someone with stable employment, regular direct deposits, a growing savings account, a decent credit score. Suddenly, everything changes. Credit card offers arrive. Pre-approved loans appear. Higher limits become available. The bank seems friendlier. Most people believe this means they've earned trust. The real reason is different. Predictability is one of the most valuable assets in banking. Banks love customers whose future behavior can be estimated. Regular income means predictable deposits. Predictable deposits mean predictable lending opportunities. Predictable lending means predictable profits. Notice something interesting. The bank isn't rewarding wealth, it's rewarding consistency. This is where the system quietly changes. Instead of making money from fees, the bank begins making money from your future. Every loan you take, every mortgage, every auto payment, represents years of expected revenue. The customer feels financially successful. The bank sees future cash flow. Those are not the same thing. Level 3, $100,000, the product ecosystem. Here's where things become interesting. Once your income and savings grow, banks stop selling individual products. They begin selling ecosystems. Checking, savings, mortgage, insurance, investment accounts, business banking, retirement planning. At first glance, this looks like convenience, but that's not what is actually happening. Every additional financial product reduces the chance you'll leave. Behavioral economists call this switching cost. The more connected you become, the harder it becomes to switch banks. The hidden incentive isn't customer satisfaction, it's customer retention. The psychological effect is subtle. People mistake familiarity for loyalty. They begin believing the bank is looking after them. In reality, the bank is protecting recurring revenue, not because it's evil, because incentives shape behavior. Level 4, $500,000, the relationship begins. $500,000 changes something important. You're no longer simply using the bank starts using relationships. Maybe you're assigned a personal banker. Phone calls are returned faster. Fees become negotiable. Problems disappear more quickly. Many people assume this is respect. It's actually economics. The real reason is simple. Acquiring wealthy clients costs enormous amounts of money. Losing one is even more expensive. Retention suddenly becomes cheaper than replacement. Notice the shift. Earlier, the system focused on controlling risk. Now, it focuses on preventing departure. The richer you become, the more valuable your loyalty becomes. Level 5, $1 million, money starts working before you do. Reaching $1 million changes the conversation entirely. Banks stop asking, "What loan do you need?" Instead they ask, "How can we structure your wealth?" Investment portfolios, securities-backed lending, tax-efficient strategies, business financing, estate planning. At first glance, it feels like premium service, but the hidden incentive runs much deeper. Large assets generate multiple streams of profit: investment management fees, lending income, trading activity, advisory services, foreign exchange, trust administration. One wealthy client can quietly generate the revenue of hundreds of average customers. This explains why millionaires often receive dramatically different treatment, not because banks admire wealth, because wealth produces leverage. Level 6, $5 million, access becomes the product. Here's where the financial world quietly splits into two realities. Below this level, banks mostly sell financial products. Above it, banks begin selling access, private investment opportunities, exclusive lending terms, specialized tax professionals, private events, direct connections, faster decision-making. Money opens doors, but relationships open even bigger ones. This is one of finance's least discussed truths. Networks compound faster than interest. One introduction can outperform years of investing. Banks understand this better than almost anyone. That's why wealthy clients are surrounded by carefully built ecosystems, because influence itself has economic value. Level 7, $10 million, the rules change. Something remarkable happens around $8 to $10 million. The conversation shifts away from earning toward preserving, taxes, legal protection, generational wealth, family governance, asset diversification, reputation management. The biggest financial risk is no longer running out of money. It's making one catastrophic mistake. The psychology changes too. Fear becomes more sophisticated. The poor fear missing rent. The wealthy fear losing legacy. Different numbers, same human emotion. Security. This is where the system quietly changes again. Banks become architects rather than vendors. Their goal is no longer selling products. It's becoming indispensable. Level 8, $50 million, the invisible world. Very few people ever see this level, which is exactly why it's so misunderstood. Someone worth $50 million doesn't experience banking the way most people imagine. They rarely wait in lines. They rarely apply for standard loans. Many don't even visit branches. Entire teams coordinate around them. Private bankers, investment advisors, estate attorneys, tax specialists, credit experts. Everything becomes personalized. But here's the surprising part. The bank isn't treating them this way because they're important. The bank treats them this way because their capital is productive. $50 million isn't simply stored. It's deployed, lent, invested, leveraged, structured, used as collateral, moved across markets. The money itself becomes infrastructure. The client is no longer buying banking services. They're participating in financial engineering. The bank isn't protecting cash. It's protecting an ecosystem capable of generating millions more. The hidden system. At first glance, banks appear to reward wealth, but the real pattern is something entirely different. Banks reward predictability, then profitability, then influence, then permanence. Every level unlocks a different relationship. At $0, the system manages risk. At $10,000, it monetizes behavior. At $100,000, it builds dependency. At $1 million, it monetizes assets. At $5 million, it monetizes networks. At $10 million, it protects structures. At $50 million, it protects ecosystems. The products change, the conversations change, the speed changes, even the language changes. Yet one principle never changes. Banks follow incentives. Always. Most people spend their lives trying to earn more money. Very few spend time understanding how money changes the behavior of the institutions around them. And that may be the greatest hidden lesson of all. Because wealth isn't just about buying better things. It's about entering entirely different financial realities. The higher you climb, the less you pay for access, and the more access begins creating wealth on its own. The system was never designed to treat everyone equally. It was designed to allocate attention where capital creates the greatest return. And once you recognize that invisible rule, you'll stop asking how much money people have. You'll start asking what level of the system they're actually playing in. Because in the world of banking, your balance doesn't just measure your wealth. It determines which version of reality you're allowed to see.